what's happening in the markets. And here we are with the Dow near an all-time high, touched it actually for a minute this week. And, of course, why did that happen? We spent a lot of time talking about the Federal Reserve and what they're going to do. Mm-hmm. They lowered interest rates 50 basis points. That spurred on a market recovery. And then as Danny opened up, China came out with some news as well.
The China news, I thought, really almost overshadowed all of the worries about what the Fed might do next. So that was kind of a refreshing change of pace, just because the news flow out of China over the last year has been pretty downbeat, I would say. Actually, ever since 2021, when their market hit a high, it is now at about 50% of what it used to be. And the government over there has finally stepped up and said, we're going to do some stimulus. There's been hints that they might do it, and they've been doing things in drips and drabs, but it really started this week, which I think is actually, the timing makes a lot of sense, because October 1st is the start of a week-long national holiday where they're celebrating the formation of communist China. And so they wanted to launch some stimulus before all those celebrations began to give some people something to cheer about. So they cut interest rates. They have announced that they're going to actually be doing handouts to lower-income individuals. They're going to try to prop up the property market, bail out some of the indebted local governments. So even though this is everything that they've said, they now have to implement it. You've actually seen their equity markets rally ferociously over the last 3 days.
And, of course, you see what's happening in China, and other countries are tied to them as well. Even though they're our largest trading partner, there are ramifications around the world, especially in Europe as well.
There is. And I would say that maybe the real closest one tied is Germany. And Germany is a really interesting situation. I think that maybe a lot of U.S. listeners don't necessarily know about Germany's structure, how tied in they are to China and to Russia when it comes to trade. And when China has been going through their slowdown, and we know everything that's been going on with Russia as well, that's really dragged on German growth. And for many, many years, Germany was really viewed as being the workhorse of Europe. And that workhorse was kind of sick. That showed up with these various surveys. Business sentiment surveys have actually hit new lows in Germany just because of how weak growth has been in China and in Russia.
So sans the sick horse of Germany, right? You look at what's really happening, and of course the Fed is trying to engineer a soft landing. And we saw the inflation has come down. That doesn't mean we couldn't get a second wave of inflation. However, one of the things they're concerned about is a slowing economy. But on Friday morning, we got a trade report that suggests that it looks better, which actually improves the GDP.
It does. Yeah, the GDP revisions that we got were actually pretty impressive. Over the last few years, there's been this divide between two different ways to measure output in the economy. One is you look at what companies and individuals produce, and the other is you look at their incomes, kind of what they earn. And there had been this big wedge between the two, which was very weird. The incomes were growing slower than the overall output. Well, there's been these revisions that have closed that gap, and it was actually the incomes rose. So we actually have started from a slightly stronger point. So even though we do expect some slowing, we're at least slowing from a point of strength.
Right, and you think about what that could mean for a GDP number. If we thought it could be 2% handle in Q3, this actually just moved that up. So there is a little bit of breathing room. And the reason why I bring that up is consumer confidence continues to plunge, which really these things don't line up.
That's right. And as an economist, I always like looking at what people do as opposed to what they say, because I think it's a more honest assessment of how they actually feel. But these consumer confidence and consumer sentiment surveys have sometimes been a little polarized, driven by whether or not your favored candidate is in the White House or not. And so there has been this wedge between how people who identify as Republican versus Democrat, how they feel about their current condition, and then also about expectations for the future. But the most recent decline in consumer confidence has really been driven by the labor market. There's been this thing called the labor market differential. So the percentage—
That's deep in it, Doctor.
That's right. So we can really get into the weeds on this. But the labor market differential is just the percentage of people who think that jobs are easy to find versus those who think that it's hard to find. And as that number comes down, that has actually been a good leading indicator of future weakness of the labor market. And so that's one of the concerning signs there. And I think it's something that the Fed took notice of, which is why they're shifting their focus from inflation more towards the labor market.